On December 26th, 2025, silver hit $75 an ounce and smashed through a ceiling it has been trapped under for roughly 45 years. They will try to downgrade that sentence. Thin holiday trading, speculation, it'll fade. That is the coping mechanism of a system that doesn't want you to notice what just changed. Because a 45-year ceiling doesn't break by accident. It breaks when the old story can't hold the weight anymore. This isn't really a silver story. Silver is just where the stress finally showed up on a chart. For decades, silver lived under the shadow of 1980. Every time it ran, it got stuffed. $50 was the wall, then $60 became the wall. A whole generation learned to treat silver as a tease. Big headlines, then disappointment. Promise, then reversal. And then late December 2025 arrives, and the metal does the one thing it refused to do for almost half a century. It clears the cage. It prints in the 70s. It tags above $75, fast enough to force even the cynics to look twice. Now here's the part that matters. The breakout didn't just touch a number, it changed the psychological map. Levels like this are not math on a screen, they are habits. They are the places where traders have been trained to do the same thing for decades. When a level like that fails, all the old behavior gets scrambled at once. Shorts who were comfortable suddenly have to cover. Risk managers suddenly have to reduce exposure. People who ignored the metal suddenly have to reprice it in their models. And the public, who doesn't care about charts, starts hearing a single phrase over and over, all-time highs. That's how a market shifts from being ignored to being talked about, not gradually, suddenly. So let's stop pretending it's just a move. Let's talk about what happened, what likely triggered it, and what history says usually comes next when a system starts cracking around a level like this. Start with the pressure gauge everyone avoids. Debt. We now talk about global debt in the hundreds of trillions. The United States alone is spoken of in the high 30 trillion range. That's not a statistic. That's a structural constraint. That's a system that can't tolerate sustained high rates without something snapping. Debt at that scale isn't paid off. It's rolled over. It's refinanced. It's managed. And managing it means the cost of money has to stay low enough that the interest bill doesn't turn into a guillotine. So the system is trapped. Keep rates high and you crush the debt engine. Cut rates and you risk the currency. Either way, confidence gets tested. And when confidence gets tested, people start looking for something that doesn't depend on policy staying perfect. That's where silver enters the room like a fire alarm. Because silver is not a giant market. The physical market is tiny compared to the ocean of paper wealth in stocks, bonds, and credit. That's why silver moves in cliffs when flows shift. Narrow door, heavy crowd. You don't need everyone to buy silver. You need a small percentage of big capital to decide promises feel riskier and tangibility feels safer. That's it. That's the whole mechanism. And there's another layer most people never think about, the paper market versus the physical market. On screens, silver trades like a liquid instrument. Futures, options, ETFs, synthetic exposure. It looks infinite. Click a button, buy 1 million ounces in a second. But physical silver is not infinite. Physical silver is mined, refined, shipped, fabricated, and stored. It has bottlenecks. It has delivery windows. It has inventory that can be pulled forward only so far before you hit out of stock. So when money starts rushing from paper claims toward physical certainty, the system doesn't adjust smoothly. It lurches. That's why breakouts like $75 can feel like the market is being chased. Because in a stress moment, it is. It's being chased by the realization that the paper price can pretend, but the physical chain cannot. Now here's the part that makes December 26th look less like a random event and more like a switch being flipped. When a market lives under a ceiling for decades, it accumulates pressure underneath it. Not emotional pressure, structural pressure. Positions, hedges, strategies, rules. The ceiling becomes a magnet for the entire ecosystem. Then one day, the ceiling breaks and all the trapped energy releases at once. Stop-loss orders trigger. Trend systems flip from sell rallies to buy breakouts. Funds that were neutral suddenly have to chase because their mandate says they cannot miss a new trend. And companies that use silver, directly or indirectly, start reevaluating what their hedges should look like when the old range is gone. That is how you get moves that feel too fast. They are not too fast. They are compressed reactions. Now, to understand why this matters for your money, you need to understand a simple truth. Metals are not just commodities. Metals are signals. They are the oldest lie detector in finance. They move when confidence moves. And confidence is not behaving calmly right now. So let me show you the pattern that keeps repeating through history. Because silver's $75 print looks like the beginning of a familiar phase. There's a 4-stage cycle that shows up across empires and currencies. Stage 1, a system earns trust by claiming discipline, a constraint, a rule, a promise. Maybe it's metal backing. Maybe it's balanced budgets. Maybe it's simply, we will be responsible. Stage 2, the system gets expensive, wars, social promises, political survival. The temptation to borrow from the future becomes irresistible. Stage 3, the cheating becomes normal, not all at once. Slowly, with new labels, with soothing language. The public stays calm because the surface still looks stable. Stage 4, the math becomes impossible to ignore. Confidence breaks faster than the printer can patch. Hard assets reprice violently, not because they are magical, but because the measuring stick just admitted it's been distorted. That cycle is not theory, it is recorded behavior. Rome is the old example, but it is clean. The coin had credibility, the empire got expensive, the metal content got shaved, prices rose, trust died, and people fled into anything real. You can threaten citizens, but you cannot intimidate arithmetic. Revolutionary France is the paper version. Notes were issued with a convincing story, then the story needed more notes, and then the government tried price controls and punishments like they were a spell. The spell failed. The paper turned into wallpaper because the credibility evaporated. The 1970s is the modern anchor cut example. A constraint is removed, inflation bites, and hard assets become the escape valve. Silver's old peak was not just a crazy episode. It was the market trying to find something solid while the measuring stick was wobbling. Now look at today. Different slogans, same plumbing. For decades we were sold a narrative. Inflation is dead, central banks are in control, debt doesn't matter because growth will handle it. That narrative acted like a constraint. Not a perfect one. A believable one. Then 2008 happened and emergency became policy. Liquidity became reflex. Low rates became baseline. Each crisis got the same medicine, bigger dose. That creates an addiction. Once your economy is built on cheap money, you can talk tough about tightening, but the moment something breaks, the system demands relief. Not because leaders want it, because the machine is wired for it. So you get a cycle of contradictions. Tighten to fight prices, then pivot to rescue stability. Promise discipline, then introduce new facilities. Talk about responsibility, then expand deficits. This is what a late cycle system looks like. It is not steering, it is reacting, and markets can smell that. Here's the uncomfortable part. A lot of modern wealth is built on one assumption, that the future will remain stable enough for long-dated promises to be honored without dramatic dilution. Bonds assume the currency remains credible. Bank deposits assume the banking system remains orderly. Retirement projections assume policy remains consistent. When you start seeing hard assets push through multi-decade ceilings, that's the market whispering that the assumption is being questioned. And the whisper becomes a shout when the level is as historic as $75. Now let's talk about the word people keep using, Stage 4. Stage 4 is not the apocalypse. Stage 4 is the end of the old range of acceptable stories. Stage 4 is when people stop asking, will they print? And start asking, how much will they have to print? Stage 4 is when capital stops trusting the narrative and starts trusting scarcity. Stage 4 is when assets that were sleepy become explosive because the demand is no longer investment demand. It becomes exit demand. Exit demand doesn't need everyone. It needs urgency. And urgency is exactly what a $75 break can create, because it tells the world the ceiling is gone and the next price discovery could be anywhere. Now I can already hear the pushback. But silver is industrial, but it's volatile, but it's not money like gold. Fine, let's grant every objection. Even if silver were purely industrial, it still becomes a stress signal when it moves like this, because industry hates volatility. Industry likes predictable input costs. A metal breaking out after decades is a problem for planners. It forces hedging. It forces inventory decisions. It forces behavior changes. And those behavior changes can feed the move. This is the loop people underestimate. When prices rise, the natural reaction is to assume demand will fall. Sometimes it does. But in a supply-tight market, rising prices can cause demand to pull forward. Buyers panic. They stockpile, they hedge, they lock contracts. They try to get ahead of the next jump. That doesn't calm the market. It tightens it. So, silver's move can be both a signal and a driver. It signals a stress shift, and it triggers real-world reactions that amplify the move. That's why you should treat this as a regime shift until proven otherwise. Now, let's get practical, because the next phase is where most people get wrecked. A breakout does not guarantee a straight line up. In fact, the market often does the opposite. It breaks out, then it tries to punish the believers. It pulls back, it whipsaws, it makes you doubt your own eyes. That volatility is not proof the breakout failed. Volatility is the weapon used to shake conviction during a regime shift. Up $3, down $3. Headlines that sound scary, headlines that sound calming. The goal is not accuracy. The goal is motion sickness and exhausted mind cells. So if you want to survive the next 12 months, stop treating this like entertainment and start treating it like a diagnostic. Ask better questions. Is the system becoming more disciplined or less? Is debt growth slowing or accelerating? Are deficits shrinking or expanding? Is policy restoring constraints or inventing new ways around them? Are leaders incentivized to accept pain now or to push pain into the future with dilution? Because constraints rebuild trust. Cheating destroys it. And silver just voted that trust is weakening. Now let's talk about why the move can get aggressive from here, even if you don't believe in silver. Most large pools of capital are not positioned for a credibility event. They are positioned for normality. They are positioned for markets that mean revert, for inflation that politely returns to target, for policies that remain stable. In other words, they are positioned for stage 1 and 2. When the world starts smelling stage 4, those portfolios don't need to become all in. They just need to adjust at the margin. And marginal flows move silver because the market is small. Even a tiny reallocation multiplied across pensions, institutions, and corporations trying to hedge costs is enormous relative to a thin physical supply chain. That's why silver often sleeps for years and then sprints. It doesn't do polite stair steps. It does cliffs. Now, I want to give you a simple way to keep your head when the next whipsaw hits. Stop watching only the spot quote. Watch the friction. When markets are calm, friction is low. Paper and physical move together. Availability is normal. Delivery is routine. When markets are stressed, friction rises. Premiums widen. Lead times stretch. Inventory disappears. The headline price can dip, while the real-world cost to acquire metal refuses to follow. Friction is the truth leaking out. And in regime shifts, the truth leaks out before it becomes a headline. And one more detail, because it explains why this breakout can matter even if you never buy a single ounce. When confidence gets stressed, policymakers usually face the same fork in the road. Option 1 is discipline. Keep money tight, accept recession risk, accept defaults, accept political pain. Option 2 is relief. Lower rates, add liquidity, smooth the system, and hope the credibility cost shows up slowly. History says systems choose relief more often than discipline because relief wins the next election and discipline loses it. That's why markets watch language more than laws. A single phrase like supporting stability can be the signal that the pivot is coming. So in the weeks after a breakout like $75, watch the tone. Watch whether the talk shifts from fighting inflation to protecting growth. Watch whether the priority quietly moves from purchasing power to preventing a credit accident. Because if the system chooses relief, the currency pays the bill, and hard assets tend to keep repricing until the bill is acknowledged. And here's the cliffhanger. The bill doesn't arrive all at once. It arrives in waves, a pause, a rally, a dip, then another surge. That rhythm is what traps people into thinking it's over right before the next wave hits. Now I want to test your instincts with 2 questions, because your first reaction tells you what decade you're living in. When you heard silver at $75, did you feel excitement or disbelief? Did you think new era or trap? Be honest and drop it in the comments. And if trust itself starts wobbling, what's your personal anchor? Cash, land, metals, business, something else? I want to see how people are thinking. Now, quick and simple. If you want more breakdowns like this with no fluff, subscribe. Short and effective. Stay ahead. Silver broke the 45-year ceiling at $75. That is not a trivia fact. That is a warning light. The question is not whether you like silver. The question is, what does a world look like when confidence starts repricing itself? And the measuring stick can't hide it anymore. Because once the market starts repricing credibility, it doesn't politely stop at the first number. It explores. And exploration is where the speed surprises everyone.